Welcome everyone to our third Friday legal webinar for the month of April. My name is Sandra Vidrio, and it is a pleasure to connect with each one of you and have you join us for today's very important topic, focusing on raising capital and the legality that comes with being able to access such funding. So with that being said, we are joined today by the team at New Business Community Law Clinic for today's presentation. I want to remind you to please use the Zoom meeting control options as you are interacting during the presentation. To be able to access that, you can use the chat box feature to leave your questions or comments. And if you're using a mobile device, please select the more option on your tablet or your smartphone to be able to find the chat option by selecting more, and then you'll see chat. This is our agenda for today. I'll go ahead and get started with some exciting announcements here on behalf of the Fresno Area Hispanic Foundation. And today we are joined by Bill Cow, Clinic Director at New Business Community Law Clinic, to be able to provide today's presentation and a Q&A session after the presentation. I want to share with you a little bit about the programs that the Fresno Area Hispanic Foundation has here available to those startup business owners, new entrepreneurs, existing businesses. First off, here with our the opportunities that we are currently having with marketing, visibility, networking opportunities. We're slowly bringing more of our in-person events for you to be able to continue building relationships, connecting with opportunities to be able to expand get your business name out there in the community. So we have some exciting events happening, and we also have our director who can provide more and who can guide you through the process of being able to import and export products if you are looking to tap into those business opportunities. And we have our CDFI team that's currently operating different loan programs available for those that are looking to start a business, or perhaps you're looking for working capital to grow your team, move into a new location. And I'll be sharing a little bit more about those loan opportunities that are currently available through our CDFI department. And for our Women's Business Center, I'm happy to share that we will be launching a new cohort of the Womanpreneur Latinapreneur program in mid-May. And we are also continuing to bring new in-person opportunities for those that are alumni, those that are looking to participate, have access to our remodeled training center at the Downtown Business Hub. So as you can see through these four core programs offered at the Fresno Area Hispanic Foundation, in addition to the many other programming available, we are here to help and support you to reach those business goals of yours. So feel free to give us a call, and I'll share right now our contact information. For now, I want to just quickly share with you about the loan programs that are available. Depending on the type of loan that you're seeking, the use of the loan, and of course, your geographic location, we will be able to figure the best loan available to be tailored to your needs. So some of these loans can be used to pay for business expansion, used for working capital, launching a business, purchasing equipment. There are different options. Of course, COVID relief assistance could also be part of the use of these loans. So here is our contact number to give us a phone call and explore more information about these opportunities. And we also have a consumer loan program, and this is available for those individuals that live in rural areas. If you are in an area that's considered rural, you have opportunity to be able to access affordable and easy personal loans to pay off high interest debts of credit cards that you have, pay for unexpected expenses that you may have incurred during the pandemic, and also being able to make home improvements. So you can contact our colleague, Miriam or Ruby, for more information. And you can also send us an email at incubator@fresnodbh.org to be able to answer additional questions tailored to your needs. And I also want to take this time to briefly share about the California Dream Fund that our organization is currently collaborating here with the California Office of the Small Business Advocate. We just launched our first cohort of the program, Startup Bootcamp, earlier in the month of April. And so we will be continuing different programs throughout the year. So if you are interested in learning more about this great opportunity, or simply wanting to participate in these business trainings, give us a phone call or send us an email to the email provided previously so that we can provide you with more information. And I do want to disclose that this program is geared towards those business entities that registered exactly July 1st, 2019, or a date after, or they're in the process of wanting to launch their own legal entity. And there's some other requirements as well, but that is for sure the primary eligibility here for this program. And once again, here is our contact information. Make sure to give us a like on our different social media platforms to keep up to date with on-demand events and other programming that the foundation has here available for our community. And with that being said, it is now turn to pass it on to William Cow. So Bill, I will go ahead and make you host so that you can share with us your presentation. Thank you.
Great. Hey, welcome everyone. Sandra, I just have a quick question. So during that introduction, there were several times when you sort of froze. I was just a little concerned that maybe that would happen while I was presenting. What should we do? Should we, should I maybe have like a backup Zoom that people could jump to, you know, that's under my Wi-Fi, or what would you like to do?
Okay, I do apologize for that. And I think, let me check if I could switch Wi-Fi browser. Give me one, or connection. Let me try this out. Okay, is that better?
I hope so. I guess we'll just have to see.
Okay.
But here's, why don't I, while we have this here, why don't I put this in the chat, that if somehow things freeze up, then, oh, looks like somebody else coming in here. So I'm going to put in the chat right now an alternative Zoom link, just in case somehow we're not able to keep it going through Fresno and Hispanic Foundation. Then if people freeze, let's say for like 5 minutes or something like that, then everybody assemble on this new Zoom link, and I'll record that too. So
we can merge the videos together. Perfect. Okay, thank you.
Hey everyone, nice to see you. Thank you for joining in today on this Friday. Yeah, we're going to talk a little bit about capital today. Let me put my screen up here. Second. Here we go. Get that up. Get the first page up here. There we go. Hopefully everybody can see that. And let's see. And we are recording right now, right? Right, Sarah?
Yes, we are recording.
Okay, sounds good. All right, guys. Well, so a couple of things to think about. So here's raising capital. But before we do, I just wanted to note, of course, this is, you know, not legal advice. We're giving you general information about the law and about capital options and stuff. So if you would like some individual advice, you know, just sign up at the end of the workshop today. We'll have our website where you can sign up for office hours. These are these 1 hour free sessions for people who can't afford an attorney. And we usually do them Monday and Wednesdays, 11 to 2 p.m. You sign up through our website, or for a future third Friday, you can also sign up through Sandra. You can just send her an email saying you want to sign up. And we do those in English and in Spanish. So just going forward there. And before we start, I also thought we should flag that taxes are due soon, people. So just so you know, April 18th is the filing due date this year. You could get an extension, but you know that doesn't allow you to avoid paying the extra interest and penalties on anything that's owed. That just means that they're going to be okay about you taking more time to put in your return, and I'm doing that myself for sure. So just know that, you know, if you don't pay the taxes on April 18th, there's going to be additional, you know, interest and penalties. Not too bad, I hope. Let's see, just so you know, there's a couple other ways. So you don't have to have a Social Security number to pay your taxes. You can have a tax ID number. We can help you figure out how to get one of those if needed. There's also this thing called the Cal Earned Income Tax Credit. If you have a child under the age of 6, you might get some extra tax credits from something like that. There's also this thing called free tax prep that has a really good overview of different different things you can do to try and minimize your taxes or get refunds or stuff. Same thing with this thing called the American Rescue Plan that can boost refunds for many families. So try these 2 links if you're struggling to pay your taxes or just looking for ways to save on your taxes going forward. But remember, April 18th is the deadline. Okay. All right, so now we're going to go to raising capital at this point to help you pay your taxes. Here's the agenda for today. So really 4 things that we're going to try and cover. Certainly give you a sense of what kind of capital you can use in your business. Well, really it's what are the types of capital that are out there? Where can you find them? And then we're going to identify sort of which of these capital sources are going to work best for your type of business. If you're a sole proprietor, an LLC, a corporation, something like that. And then finally, some strategies for raising capital with investors, how to talk to them and get them potentially on board and potentially use them to help network with other investors going forward. So we're going to cover that today too. But then this last thing, I just didn't know where to park this, but a number of you folks might qualify for minority business certification in the state of California. And that's another way to not so much raise capital. I mean, I suppose there could be investors who might want to only invest in a minority business, but also it gives you an edge in state contracts because certain percentage of state contracts have to go to minority businesses. So once you get this certification, it can be a real, boon to your business. All right, well, let's get started. Let's see, what capital, what is capital, I guess is the main thing to say. The thing you should just note here is we're talking about 3 areas, 3 types of capital. Of course, the personal funds that you put into your business, any debts that you take on or loans, all right? And then equity. This is selling an ownership share of your business to somebody else. That gives them some potential to share some profits, also potentially gives them a little bit more control over your business than before. So we'll go into these in a little bit more depth going forward. So let me focus on the right side here first, and that is to say, an entrepreneur's challenge in all of this is always to find a good balance between these 3 types of capital. You don't want to have so much debt that is just going to strangle your business, but at the same time, you can't put in, so much personal funds that you bankrupt your family. But here's some sort of plus and minus there. So like personal funds you might get from yourself or your family. The benefit there is, of course, you don't have to pay it back if you fail. But yeah, as I said, you just can't, have your family, totally bankroll your thing, your business, such that it, gives them trouble paying their bills or paying their rent or stuff. Here's the thing: you don't need to give them up any kind of control because they don't care, or they don't want to be on the board of directors of your business or stuff like that. However, if you do fail, you will still have to pay them back unless you created some kind of separation between you and the business. We'll talk about doing that later. But yeah, debt is something that is sort of with you until it's discharged. Right. And finally, this thing called equity, or selling an ownership share in your business. Yeah, here you go. Like my brother-in-law, who started this thing called pets.com long ago. Oh gosh, I wish he had started Chewy. Chewy's a very successful company. Pets.com went down pretty fast. So he said, hey, how about you want to invest in this? And we did. And here's the thing, no need to pay it back if you fail. And they failed terribly. But technically, while we were shareholders of that company, we did have a little bit of control over it, not enough to keep it from going under. But anyway, those are the trade-offs with those 3 types of capital that you have there. And now, to the left side here, where do you get this capital? Well, of course, Founders put in their own money. You might get some money from family and friends. You got your banks. You might have private creditors, or like Fresno Area Hispanic Foundation might be a source of some loans that you could get as well. Equity investors. This is the group that we're going to be talking about a lot more here. How do you find them? Where are they? Sometimes they're called angels. Some are venture capitalists or other things like that. We'll talk a little bit about what these people are and how you get connected with them. There might be some grant agencies, usually they don't give to for-profit businesses, but during the pandemic, there were some relief that came through private foundations and stuff. Government, again, tends to only go to nonprofits, but again, during the pandemic, did give out some small business loans and stuff. And then, of course, you have to think about, well, why do I need the capital going forward? Well, I would say that most kinds of investment or things that you're going to get funding for deal with like startups or things that are going to be like one-time expenses. I mean, a bank could give you like a credit line to help you with ongoing expenses and stuff, but it's a little easier to justify, sort of one-time capital expenses that then you could, pay off over time, or it's just not going to be a recurring sort of revenue problem for you going forward. However, as I said, there's lots of different kind of capital out there. Investment capital can help you with ongoing expenses as well. All right, well, let's go next to where do you find this stuff? Okay, well, there's basically three places to find the capital here. One is, for loans or debt capital, that would be banks or private people or organizations giving out these kinds of loans. There is this thing called Kickstarter. Kickstarter is more of a pre-sale kind of service that allows you to put up before you're developing your prototype, selling the prototype in shares, or the ability to buy the prototype like at a cheap price. And that way, then you accumulate the capital enough to make the prototype, you see. We'll cover this in a little more detail in a second. But then, and this is where we're going to spend most of our time, selling ownership shares of your business. Yeah, one reason we're going to spend a lot of time on that is it's, takes a lot of hustling on your part, takes a lot of talking to investors and stuff. And it's also very highly regulated. And so we got to make sure you do it the right way there. All right, well, let's get started on each of these here, okay? So loans from banks or private lenders. Well, if you're setting something up like this, you're going to be using what's called a promissory note. It has several terms that you have to think about. Certainly how much money you're borrowing. Oh, by the way, of course, you want this in writing. You definitely don't want to do a loan on a handshake deal in any way. Just trust me, what kinds of problems you would buy with something like that, people not remembering what terms they gave you done. You wouldn't, if you have outstanding loans, it's going to be hard to get loans from other people, if they think you haven't been sort of, how would I say, formal enough in setting these things up. So yes, definitely written promissory note is what you want to use. But here's what you put in it. Okay, so how much you borrowed, yes. Interest rates, wow, I actually looked at the interest rates. I used to have something in here saying watch for usury rates. And I was like, oh, well, I wonder what the usury rates in California are. You might be surprised to know that it's 10%. What? 10%? I mean, I've got like 3 credit cards that are like 24% at this point. Well, this is the thing. In California, they really haven't updated the usury laws yet. By the way, you should know that in the Bible, it talks about, thou shalt not charge usury rates. That's even where it uses the term usurious rates for loaning money to other people. So it's quite a long time ago when people were saying, yeah, it really shouldn't be gouging, you to take out a loan. Well, here's the thing. In the state of California, they exempt basically any business from the usury rates, loan business from the usury rates, if it's organized by a bank. Okay, well, great. That's a pretty state law there, but yeah, so it needs to really be updated. As I understand, there's a state bill that's going in. I don't know how far it'll go, but to actually set the usury rate at 36%. I mean, that's horrible, but apparently that's going to be, fought by the banks, even that. So just what I'm saying is, think of the interest rate that you could reasonably pay back within a period of time. These sort of same day payday loan type of things are not giving you interest rates that are reasonable or paybackable in a reasonable period of time. All right, so interest rate, think of the going rate. Banks will give you the, sometimes it's like a percent or two above the prime rate, which right now I'm not sure exactly what it is, but anyway, watch the interest rate, I guess is what I'm saying. Certainly payment schedule, and there's different ways to set up the payment schedule. Maybe you actually tie it to when you're starting to make money, when you hit a certain payroll, a certain number of employees. I haven't seen that so much, but it's certainly a number once you get to a certain profit for a certain months in a row. But sometimes it just starts on a particular day. So you work that out. Collateral, that would be a piece of property, or, it could be personal property. It could be real property like land that you put up in exchange for the loan. And so, they can foreclose against that piece of property if you don't pay back. And then they'll have some kind of default process. Hopefully that default process will have an ability to cure. So for example, if you didn't pay your mortgage or your loan by the 10th of the month, as it says on there, it has to pay, it won't go immediately into default. It'll say you have like 10 days to cure it. Okay? So I'd look for those kinds of things in a loan agreement. And now here's a really important part is who's going to be the one on the hook to repay this thing? Well, if you're lucky, your bank or your lender will say, well, I'll have it, it'll be the LLC, the limited liability company that you own that will have the loan, or the corporation that you have the loan. That would be great, because then that creates separation between you and the business. And if they have to foreclose, then they can't come after you personally. They can only go after the business assets there. Oh, by the way, Sandra, I don't know if she said this at the beginning, but if you have questions, please put them in the chat, because then once we finish, we'll go through those questions one by one. All right, and the final thing I just say about a loan is just make sure that a lawyer, if you can, reviews a loan agreement before signing, just to avoid possibility of overreach or exploitation for you. All right, now there's this thing, as I mentioned, called Kickstarter. Kickstarter, yes. So let's see, let's say I'm a pie baker. I'm going to be selling my pies at $20 each, but I need a little capital to get going to pay for my oven or my hood or something like that. Okay, well, then I might go on Kickstarter and say, hey, I'm going to sell these pies for $20 each. If you give me $100, I'll give you 10 pies, and that would be for $10 each, you see. So if you give me 100, then I can start paying for some of this equipment I need to actually make the pies. And then, of course, you have to follow up and give the pie to the people that they prepaid for. Now, one thing you should know is there's this thing you're going to learn about in a second here called a security. Okay, a security is essentially, the best way to describe it is like an investment contract, meaning you give me money and I'm going to do something with it that's going to give you an advantageous outcome. Okay, so you're going to give me a loan and I'm going to pay it back to you with some interest. Okay, that's actually a loan is a security, as is investment. You're going to give me some investment in my LLC and I'm going to give you a profit share. Okay, as you might guess, these things, securities, are very highly regulated by the state, and I'll explain why in a second. But you should just know that this thing, Kickstarter, technically not a security. Why is it? Because you're just promising to pay for something, promising something in advance that people are going to pay you. It's sort of like they're paying on time, but you're the one who gets to perform on time, you see. Okay, so you don't have to worry about these kinds of arrangement pre-sales as being highly regulated by the SEC or something like that. All right. So now we're going to start talking about things that are highly regulated. It's called ownership shares or equity. Okay, there are two ways to do this. Okay, you should just know that what happens when you do sell a piece of your business to an investor. Sometimes it's called an ownership share or equity. In a corporation, it might be called stock or corporate shares. In an LLC, it might be called an LLC ownership interest. So it has a couple of different names to it there, but it all means the same thing. It means that you are sharing with the potential investor a portion of the profits. Yes. And it also probably also comes with the right to exercise some control over management. So a shareholder in a corporation gets to vote on the board of directors, the people who sit on the board. Okay. So you should just know that it comes with a lot of regulations. There's two forms of it. The newest and sort of most widely, how would I say it, widely used by everybody is crowdfunding. And we're going to talk to you about that in a second. But then there's also these things, for lack of a better word, traditional sales of securities, meaning like the stock market or things like that. Okay. So let's start with crowdfunding. Oh, actually, let me give you an overview of these two, just to sort of preview it. Okay. So crowdfunding, it's actually one of the few pieces of legislation the Republicans let Obama get. It's, I mean, a great piece of legislation. It was called the Federal Jobs Act that was passed that allowed people to go online and invest in companies according to their income level. And why is that new? Well, I'll tell you in a second when we get to traditional sales of securities, which tend to only go with rich people. Crowdfunding is basically for everybody. You can go to one of these portals. It's called like Indiegogo or GoFundMe or something like this. And then individuals of all incomes can potentially invest in your company. Okay, it is limited based on the amount of income that they have during a given year. And I'll tell you in a minute what this, how they usually do this is through these things called convertible notes, which you'll know what those are in just a couple of minutes there. But before crowdfunding came along, you got traditional sales of securities. Ooh, yeah, doesn't that sound imposing? Yes, it is, because they are highly regulated by the federal SEC and by the state of California. But here's the thing. If you're a small business, there are some exceptions. There's exemptions or exceptions, I use the same word, for small businesses to do limited sales of their ownership shares without getting into trouble with the SEC and without having, these major disclosure or paperwork or costly things that you have lawyers have to do. Okay. But the thing is here, unlike crowdfunding, where everybody can participate, traditional sales of securities tend to only be able to allow you to have insiders get ownership shares of companies or rich people called accredited investors. Okay, and we're going to tell you what an accredited investor is in a second. But let's go into this a little bit more. First, let's start with crowdfunding, because that's for everybody. Okay, well, look at these nice sites that everybody can jump in on: Seed Invest, Indiegogo. By the way, we started Indiegogo. Isn't that amazing? Back in 2009. Now they're a multi-billion-dollar platform. They haven't come back to us, though, in terms of charity yet, but that's okay. We'll keep them on our list there. Anyway, so crowdfunding, you just know, is this using the internet to raise money from small investments from a large number of participants, okay? Let's talk a little bit about what that means, okay? If you go to Indiegogo, you go to GoFundMe, they'll put up there, it's actually kind of like a marketplace, because they have all these different potential investment opportunities out there, and it has a search engine. So you could probably say something like, well, I'd like to invest in a company that's, I don't know, I'd like to invest in a beverage company. Okay, well, all of a sudden you'll see like probably a good 50 or 100 different beverage companies that are looking for investment. And then they'll have some information about them, some financial information about them. And if you see one that you like, then you can start this process of investing. And what they're going to do is check your income. Okay, well, first thing on the company side, there is a limitation on the company side. You can only raise up to $5 million a year. It requires them to disclose, financial statements and stuff. If they are raising more than 500,000, they do have to provide some audited financials. So there's a little checking on that side. They have to have a business plan. They have to say how the proceeds will be used. They'll have to describe how the company's structured in terms of ownership. Yeah, so they have a few things, you're going to see when you go on the site there, it's not just anybody coming along and putting up some data. It's they've actually vetted these companies a little bit, you see. All right, now on the investment side, here you go. If your net worth is less than 100,000, well, you could invest up to 5,000 a year. Okay, if your net worth is over 100,000, then you do it percentage-wise, 10% of your annual income, a maximum of 100,000 a year. All right, and the portals like Indiegogo will be checking these levels for the investors. Companies themselves don't have to do it. All right, so you might go to Indiegogo or one of these things and put up basically a notice about your company, what you're going to use the money for, and it's a good way to get known. I mean, that's one of the pros is more increased access to capital, some exposure. People start finding out about what you're up to there. And if you're not at a point where venture capital might be interested in you, and what I mean by venture capital, we'll go into it in a second, is just investment companies that are really looking for high profits off the bat, 10 times what they put into you in terms of money. They're going to want that back within a year or two or something like that. Okay, so if you're not this skyrocket to the moon kind of company at this point, then the VCs probably won't be on their radar screen yet. So maybe crowdfunding is a way to get on the radar screen and get some investment. Now, some of the cons here, yes, those limitations on how much you can raise. Some people, are reluctant to put in money into a company they haven't heard of before. So, don't expect, major amounts of money. And of course, there's disclosures you have to do to get into the game there. But, a lot of people start with crowdfunding, especially to fund things like prototypes. Like, for example, we have a client right now at Berkeley Law, the clinic. She's trying to create a doll that sort of teaches young kids about coding, because it has some ability to, you link it up to your iPad and it does stuff when you learn about coding. Well, she's going to need to build this prototype. She's in the middle of building it. She needs some money to build that prototype. Crowdfunding might be a really good way to do it, and also to get out news about this potential doll coming on the market, you see. Okay. All right, well, now we're going to go into, this is going to take a goodly amount of the rest of the workshop here because it's just a very highly regulated space. This is the thing. So like, don't go to your church and like say, I'm starting a business. Who wants to buy some shares? That would just like immediately violate a bunch of security laws, okay? And it'll explain why in a second. Here you go. See, the context here is that the Great Depression, that we all remember this? You thought it was in the 2000s? Well, the first Great Depression was in 1929, and it was actually started in large part by fraudulent companies who were basically going around to even knocking on people's doors saying, invest in our company, it'll make you rich. Oh, and all of those things failed and people were defrauded. And so it led to these laws that they refer to as the blue sky laws. And that's because it was trying to prohibit the practice of somebody coming to you and selling you a piece of the blue sky, you see, fraudulently, of course. And that created also the Securities and Exchange Commission, the federal SEC. Okay, but then California and a number of other states have also added their own regulations because, again, they feel like they need to protect their citizens from such practices. Okay, and so any of these sort of give me money and I will give you an advantageous financial outcome from doing that, called a security. Nowadays, though, to sell securities like that or equity, a small business needs to use one of the small business exceptions to avoid major filings, major paperwork and costs. What does one of those looks like? Okay, here it is. Federal Rule 504. Okay. This is the most common one that people are using. Here's your limitations on it, though, you see. So a small business is But 504, here you got a limitation of 1 million, no advertising at all. You can't like go on TV, you can't go to your church, you can't like put ads up or something, no advertising. You can sell to unaccredited investors. These would be insiders of at least $1 million, excluding the value of their home, right? Or somebody who is regularly earning, an individual who's earning at least $200,000 a year, or as a couple, $300,000 a year. So a rich person, generally. Okay, so what I'm saying is that friends of founders or family of founders, those people, you don't have to worry about their income, all right? They're called insiders. And why is that? It's because they can protect themselves because they know you and they know you wouldn't defraud them on things, or at least they wouldn't think you would. But then accredited investors, the reason we don't care about them getting defrauded is because they're usually pretty careful with their money. They usually have advisors who So again, think of it, small business exception, either insiders or rich people. That's who you can give your ownership shares over, okay? There's no disclosures that are needed. You still might, an accredited investor might ask for a disclosure of your financials or stuff. Now here's another aspect, which is very important, is you can give people these ownership shares during the period of the restriction, while people aren't publicly trading them, on the national stock market, then they can only sell the shares back to the company or to another shareholder of the company. Or, if they're leaving the LLC, they can only sell the interest in the LLC back to the LLC or another member of the LLC. Okay. So those are some promises that people make when they are buying this, these ownership shares. Okay, so what you should know is that you actually have to register a sale of these ownership interests within 15 days, okay, with the SEC, the federal SEC, and with the state of California. Now, there is an exception. If, let's say that you are the sole owner of your LLC, or you're the sole owner of your corporation, okay, the people who are the founders do not need to register their stock or their ownership share. Why? Because it's treated as though it's not really this, give me your money and I'll give you your advantageous result from it. Instead, it's people investing in themselves, really. It's investing in the company that they own. And so the registration requirements are less for them, okay? It's only, yes, now your brother's got some shares. Oh, okay, now you have to register. Or here comes this angel who's investing in you. Oh, yes, you have to register that ownership. But just the founders themselves generally don't have to file, okay? All right, so generally, strongly recommended, get an attorney to help you set this thing up because, there's filings, there's different formalities, you have to have stock purchase agreements, you have to have shareholder agreements. If you have several shareholders, you have to have an operating agreement if it's an LLC. So it's just something that a lawyer should really help you set up. And we can help you do that, by the way, of course. If you contact us through office hours, we can help you with all this. All right, well, let's start thinking now about who are these people who are getting equity? Who are these people who are getting the ownership shares? Okay, well, here's old Zuckerberg here up on the left. If you're a founder, well, usually they get ownership shares of their own company for putting in personal funds, right? But you see, sometimes they will have their equity conditioned on working for the company for a period of time, like for 4 years or something like this. And so that then might say, well, you can get these shares of ownership shares, but only after you work for a period of time. That's what's called vesting. So that means that over a period of time, those ownership shares will become theirs over time, but they have to keep working in order to do it, okay? Let's see, friends and families. Yeah, they are insiders, they could just be giving out stock. Okay, they usually don't have vesting because they're not like working for the company, but you can give them stock or a share of your LLC, for example, with cash, or they can give you a loan, or these things, here you go, called convertibles. Convertibles. I don't mean a car with the hood down or the top down. I mean a kind of an instrument that changes from a loan to ownership shares. We're going to talk about these in just a minute here, but these are the most popular ways for usually outsiders, investors who aren't part of the company, who want to give you money in exchange for an ownership share in the future. These convertibles really help them do this. I'll explain what they are in a minute. All right, here you go. Angel investors, maybe you've heard of them. These usually are rich people, accredited investors who want to support your business, but they're usually not, trying to gouge you. They don't want to say, here's $10,000. I expect to see $100,000 next year from you. No, they're not going to look for big profits like that. They might give you a loan, or they might give you this convertible I was talking about, where it's a sort of a temporary loan that then turns into ownership later. Okay. Now then there's these venture capitalists. Okay, these are like usually big institutional investors. Yeah, these would be accredited investors looking for big profits, like 10 times what they invest within a year. Okay, now they would maybe put in convertibles. They might put in loans. They also might negotiate for some kind of preferred ownership share that nobody else gets. So for example, a preferred stock share for them might give them the ability to vote for their own board member on the board of directors. Okay, so preferred shares or preferred classes of ownership shares in an LLC are things that they're going to want going forward. Again, perks that only they can benefit from. Finally, you should just know that employees can also get in on the game, with these things called options, which then allow them to buy ownership shares at a lower price than it's offered to the public. And again, it might be subject to vesting going forward because, we want people to work, going forward and such. Okay, well, now here's the thing. How do you figure out how much equity costs? Okay, well, this is an interesting question, because you should just know that, well, at this early stage, how do you figure out what the price of the company is? I mean, if I'm giving you, I don't know, let's say you've got 10,000 in the bank, and then somebody gives you $100,000 in investment, what does that $100,000 represent? I mean, it's like 10 times what you have in the bank, but maybe your business is worth already over $100,000 because you got, I don't know, a patent or something that's really, really valuable here. Okay, well, the problem is that investors at this early stage, they don't know what the price of your company is, and it's really hard to figure out the price of your company, all right? So that's why they use these things called convertibles, right? Because what happens is it sort of sticks their foot in the door and says, we have the ability, we have a part of this company, but we don't know how big the part is yet. We're going to wait until there's a financing round where they do try and figure out what the cost is. So the first round is usually people just putting these convertibles in. And then the second round, or maybe it would be called a seed round or something like that, they actually do try to figure out what the company is worth with this valuation that they might do with a professional appraiser or something like that, or comparables, what other companies are worth that are similar. And so at that round, the people who put in the convertibles early will then be converted into ownership shares according to some formula. And this is where we're going to talk in a second what that means. Now, of course, when you get big, you're on the public stock exchange. Oh, yeah. I mean, everybody knows how much, Coca-Cola is worth and how much a share of Coca-Cola is worth. But, at this early stage, you can't get there. It's very hard to determine the cost of the value of the company. Okay, well, now let's talk about these convertibles. Okay, so as I said, it allows an investor to basically give some cash and to say, well, look, when we get to the next funding round, we're going to take that amount of cash and we're going to, use it to figure out how much you get from, the company of a share of the company going forward. All right. Usually, the most common is called a convertible debt. So that would be sort of this investor saying, well, I'm going to give you $100,000. We're going to treat it as a loan at the start. But then down the way, if you go to the next financing round, or maybe you even say, within 2 years, it depends on what's in the instrument, who does this, I'm going to convert this into shares of the business, ownership shares. Okay, so how do they set up these sort of preferred arrangements? Because, if I give money early on to this company, I'm taking a greater risk than somebody coming, 2 years from now in that sort of seed round or next funding round. So shouldn't I get a benefit from coming in early? Oh, yes, you usually do through these convertibles. Okay, so here you go. Remember that if you're doing a loan, you'd have these terms here. Okay, a maturity date. When's the loan going to be due? What's the interest? What's the discount rate? Okay. Now here's where the discount rate is a new kind of term that goes with this, different than a loan. Okay. Here's the idea. So if I gave $100,000 with a 20% discount rate, what would happen then at the next funding round, and we'll show you an example of this, the next funding round, is that means that my $100,000 is going to be treated as though it's $125,000 because I get a discount on any shares that are sold to me. All right. So another way to think about it is if the shares at the next round are worth $1 a share, then I get to buy them at 80 cents a share. Why? Because I got this 20% discount when I convert, you see? So this gives that initial investor some additional, oomph at the beginning at a time when we didn't know what the shares price was or anything like that. Okay, there's another thing that you could use here called the cap. The cap is where you think about the highest potential valuation of the company at that next funding round that will then apply to your initial investment. And I'll show you what that means in just a minute there. It's another way of sort of giving an advantage to the investor who came in early. All right, well, there's a few other things that usually go with this convertible debt. Prepayment, it does allow a company to pay off the debt early and prevent conversion if they can, come up with the money to pay it off. Yeah, so they get the investor out of their hair. Pro rata participation, this would be an example of where the investment, let's say, here you go. Let's say at the next funding round, that $100,000 investment I put in, turns out that it's 10% of the company, once they value it, okay? Well, if I had this pro rata right to participation, that means in future rounds, if I put up the capital, I can keep my 10% going forward, no matter how many investment rounds come around. Okay, it's a pro rata right to participate. And finally, here's where they think about, okay, well, not every company succeeds. There could be a liquidation preference here. Okay, this means that you as an early stage investor get paid first before the founders get paid if there was a dissolution. Sometimes this has a multiple to it, and they'll say, well, I need to get it paid back at least 100, a 1.5% of what I or something, 100, basically I get 1.5 times or 2 times what I invested if there's a liquidation, if there's a dissolution, okay? Yeah, so these are kind of standard terms in these convertibles. Now there is this next thing called convertible equity. Okay, this sort of came along after the convertible debt. It was actually pushed by one of our leading incubators in California called Y Combinator. And they have created this very simple investment tool called a SAFE. A SAFE is a simple agreement for future equity. That's what it's called. Okay. So what it means is we're just going to do away with the idea that the investor is giving you a loan at the beginning. Yeah, because many investors don't care. They don't want to be a creditor. They want to be an investor. Okay, so in this situation, they do away with all of the debt terms, pretty much. No maturity, no prepayment, no interest rate. It does allow the possibility if there's a cash, if you want to cash the person out, if there's an acquisition or a dissolution, you do get cashed out in that situation there. And it still has that pro rata right to participate in future rounds. So it has these 4 flavors to it. Remember, I was talking about the cap being one perk that an early investor gets, and a discount rate, that's another thing. So you see there's different versions of it. You could have a cap with no discount, that's called the standard safe, discount, no cap, cap and the discount. And then there's this thing called a most favored nation clause, which is actually pretty cool for the investor, because it says, okay, hey, in future rounds, if you give future investors better terms than I get them too, you see. So these are all terms that you would negotiate in, when you're putting this together. So let's now give you a quick sense of how the discount works, okay? I think I already gave you a little preview of this. So let's say the investor puts in $100,000, gets this 20% discount. Then at the first priced round, the shares are priced at $1 a share. Okay, well, that investor now gets 125,000 shares for their 100,000 investment because they'd buy them at 80 cents a share, you see? Now, an interesting thing is, this is kind of seems not intuitive, but it's the way it goes. The angel investor here would also get liquidation preferences. If they got 125,000 shares, they've paid only 100,000 for those shares, but they'd still get back 125,000 in liquidation preferences for their investment. Why? Because they get the better of whatever they invested versus how many shares they get, you see. All right, well, then there's this thing called the cap, okay? So the cap, let's say they invested 100,000 in the company, it had a $2 million cap. Well, this is where you would then do a little bit of math and you would say, okay, well, then that $100,000 with a $2 million cap means that I get 200,000 shares, because you take 2 million divided by 100,000. So again, the idea is, at the first price round, the company is determined to be $4 million, okay, and they pay $100 a share. Well, then still this angel investor gets 200,000 shares because they had the cap of this company that now is worth $4 million, you see. And again, if there's a dissolution, then they got 200,000 shares, they would still get this $200,000 in liquidation preferences for their 100,000, see? Yeah, complicated stuff. I'm trying to break it down the best I can for you guys. And of course, can go further in questions and stuff. All right, so now here's that next thing that we were going to cover. Now that you've got a sense of what are the capital sources, what are the kinds of capital you can get, which ones work for my business going forward? Okay, well, here you go. Sole proprietorships have a limited kind of capital that they can get. Why? Because they don't have separation between the entrepreneur and the business, okay? So, but they can use, of course, take personal funds from the founders. Family and friends can give you money. You can take loans, and you can use Kickstarter as a sole proprietor, okay? But notice that there's no equity that you can do as a sole proprietor. You have to have a separate entity that's separate from yourself. And that would be either a partnership, a limited liability company, or a corporation. Okay. So as you can see, they can use the same capital that a sole proprietor can use, loans, Kickstarter, and all that. But equity is the thing that they can use. And again, the equity is trading cash over for a share, an ownership share of the company. All right. Now, there is a little exception with the corporations. S corporations, maybe you've heard of this. It's a special kind of corporation that you set up the corporation at first, and the presumption is that you were a C status corporation. That just means that the IRS is going to treat the corporation itself as an entity that will be paying tax. And so the corporation puts in its own tax return, you see. But if you file for S status, then you should know that the corporation doesn't pay tax itself. It only lets all the profits pass through the corporation to the individual shareholders of the corporation. Okay, it's a special filing you have to do. The problem is it also comes with several requirements around investment. All right. So you should just know that S corporations, if you filed for that status, it's limited to humans. You cannot have an entity invest in you. Okay, very few exceptions. Most 99% have to be humans, and they also have to have legal status. So this is not a good entity if you have investors who are not, either green card holders or citizens. Okay, but such people can always invest in C corporations. They can always invest in limited liability companies or partnership. It's just the S corporation has a special status. Whew, okay, well, that's a lot. That's a lot, guys. Why don't we talk a little bit about strategies as we close here for raising funds with investors? I'll probably cover this in about 5 minutes more, guys. I know we're coming up on 2 o'clock. But here you go. This is from a really great book that you should get. It's called Raising Capital on Your Own Terms, How to Fund Your Business Without Selling Your Soul by Jenny Casson. And she's a good colleague of ours. She is also available, by the way, for consulting if you are trying to set up capital. But her book, which we use with some approval by her, gives you a sense of how to talk to investors. So let's get a little bit about this, okay? So some questions at the start. Okay, certainly you should figure out how much capital you need. Then you need to figure out who you should target for your investment, strategy, investment raising strategy. And there'll be some decision points along the way, which we'll cover. You need to know what your entity can do. We just covered a little bit about it, whether your entity can take this kind of investment capital. What instruments you're going to use. We already talked about convertibles, which are usually the most common. You have to think about what kind of economic rights your investors should have as to profits, okay? But then, they may also want some governing rights, to name their own board member or something like this. Yeah, so you have to figure out what you want your investors' arrangement with you to be. And finally, there's some perks you can offer investors, like publicity or your company's hat or something like that may be important to investors too. All right, so let's walk through these real quick. Essentially, how much capital do you need? Well, the first thing I would do here is to think about, going forward, maybe I need some staff. Maybe I need to do legal work. Maybe I need to pay my lawyer. Yeah, maybe I need to create a prototype or something. And this way, we just gave you a list of potential things that you might need your capital for at the beginning, okay? So then just make a little spreadsheet, what I absolutely need, the minimum that I need would be, $1,000 to form my entity to pay my lawyer, or I need a 0.25 FTE manager at 20,000 a year. Okay, I don't know who would take that, but yeah, I guess at 0.25 it'd be something. Oh, by the way, that's supposed to be 0.25 FTE. So that would be minimum, okay? But maybe if you really got the money, boy, it'd be nice to have a full-timer, a 1.0 if a full-time manager at 80,000 a year. And maybe, $10,000 is all our legal fees. Yeah, I'd like to be able to pay those up front. So you sort of have a, fallback, the minimum I need is this. If we're really, lucky, we'll get this, okay? All right, and then the next thing you need to think about is how many funding rounds do you anticipate needing? Figure about 16 or 18 months to reach that fundraising goal, okay? You're trying to raise about 16 or 18 months of expenses. And the reason is, you think about in 2 years, you're probably going to have a better track record. People are going to see what you're doing and you'll have a better, ability to raise funds at that point. See? Okay. Whom should you target? I'm not going to go through this in very much time, but I've already explained to you what venture capitalists are about, what angels are about. There's professional investors and there's non-professional investors, okay? Just so you know, these are people, you'll have to be thinking about whom you're going to target. Angels are a good place to start because they usually don't want a huge profit share like the venture capitalists might. So just know that there's a lot of different people out there with money that you might target. Don't go after the world. Try and target a few people, a smaller number at the beginning. Now here's where Jenny comes in and she says, okay, well, here, do a little exercise before you go after your investor. Think on what would be your ideal investor. Certainly somebody passionate about what you want to do. Maybe there's things you don't want in an investor. Do you want an investor who could actually fire you? Do you want them to have a little say in your company? Do you want them to have no say in your company? All right. So then that's where you'd identify potentially 3 to 5 people who could be your ideal investor. Okay, and maybe learn as much as you can about them through the web or through other people who know them or stuff. And now here's the little juggle thing that maybe each of you have done when you went to look for a job. Are you ready for this? Okay. You go to them and you say, I'm not asking you for money. I'm not asking you for a job. I just want to do some research. I need to think about how best to look for an investor or look for a job. You see how this is similar to some things you might have done looking for a job yourself. Yeah, so don't put the bite on them right at the beginning. Say, we're looking to raise money from investors. I respect you. You got a lot of money. I'd love to pick your brain on, what I could do in terms of strategy. And anybody else who could help me with my research here. Okay, well then you ask them, some questions here. Again, don't put them on the spot by saying, give me money. You say, what would be exciting or interesting to somebody like you? Okay, well, how long would somebody like you need to have their money tied up before they get it back? What kinds of things could we do to make it more attractive? Help introduce you to other people here, you see. And now, here's some important decision points. Of course, as I said, investors can't invest in a sole proprietorship. You're going to need this legal entity. Here's one thing you should know is that investors sometimes like investing in a company that will have losses in the first couple of years. Why? Because they can take those losses if this is what's called a pass-through recording again. There you go. So you think about what economic rights your investors should have. When are they going to get their profit shares? Should they be able to re-up with more money and get more profit shares, things like that. Some other things about, as we get out of the company by just selling their shares to somebody else. Usually they have to offer them back to insiders in the company, you see, or other shareholders or stuff like that. So this is how they're going to be making their money going forward. Finally, governing rights, usually if it's just a debt that they're giving you, usually they don't get any control rights, but equity investors, yeah, they might want to have some voting on different things. They might want to have some say when you hire somebody. These are different rights of, that they may feel is important to protect their investment going forward. Okay, finally, other perks. Okay, so there might be some tax implications for these things. All right, well, the last thing that we wanted to cover is just this minority business owned certificate. This isn't a way of getting capital, but it is a way of potentially situating your business in a more positive way to get state contracts, you see. So you just know that there is a certification through the U.S. Small Business Administration. Go to this link to look this up. It has to be companies with 51% minority ownership share or more. And as you said, 5% of federal contracting is reserved for these, what they call 8A minority-owned businesses. And then there's one in California too. Yeah, in California, you go to this can go to that link, www.law.berkeley.edu/NBCLC. And that way you can sign up for office hours, or you can just email us at newbusinesslaw@berkeley.edu. Phew, okay, that was a lot. Let's go to see if we've got some questions in the chat. Okay, let's go back here. I think I can go up a little bit. And Sandra, I did begin to record this thing again. I don't know how it got blocked out, but it stopped recording at a moment, but I'll put these together. Question from Mr. Keller. I was trying to pay the tax for the LLC, but it's stuck in the taxable year. Okay, I created the LLC in February 21st, 21. States the web page from the franchise tax board would be 20. Great. Well, I don't see any other questions. Anybody want to unmute? And if you have direct questions, we can talk.
Yes. Hey, Dr. Kell, it's Frank.
Hey, Frank. Nice to see you. How are you?
I'm doing good. Thanks for asking. I was typing my question in, but it's a little bit lengthy. So
okay, that's all right.
Glad you opened up the mic. But my question is, if I was an investor, I know that we covered a lot of the the entity part, but what if I was the investor, what should I be looking for with regards to if someone approached me to invest in their company? Like, what are the things that I should be looking for?
That's a really good point. Actually, Frank, I actually have a whole PowerPoint on what investors look for that I can send you. It's called due diligence. And I'll just pull out a couple of thoughts about it. First of all, I'd want to make sure that the company did comply with all the formalities. Like, if they say they're an LLC, I would look them up and say, are they in good standing as an LLC? Maybe you'll find that they didn't even file their forms as an LLC. Same thing with a corporation, same thing. Make sure that they're in good standing with the state of California. I would look for, I would look to see, do they have a written operating agreement? Do they have, if they're a company, if they're a corporation, do they have shares that they've actually issued, and have they kept track of who they gave their shares to? You'll be surprised how many people, that come to us and say, well, I'm supposed to put this all in a cap table? That's what it's called, a cap table that keeps track of the shares. And they're like, well, I gave so many shares out and I don't know what I gave them to for what? Well, wow, why should I do this? Well, it's because somebody like you should not invest in a company when they don't even know who owns it at this point. That's one thing. Another thing is, if there's any potential disputes between founders. Here's another thing: if they have intellectual property, that like a patent or something like that, and they haven't put it into the company, well, they could easily give that to somebody else. And so then you think you're investing in the patent, but sure, it's only going to be worth it if the patent is actually owned by the company.
Yes, absolutely.
So actually there's several other things. let me write down here. I'm going to send you this overview PowerPoint of what you look for in a company. Okay, that would
awesome.
Be good.
I appreciate it. Do you still have my email, or should I just put it in the group chat?
No, I got it. I got your email. Yeah.
Awesome.
All right, we'll send that off to you. Other questions that people might have? Okay, well, it's been great talking with you all. I know it's a really complicated topic, so feel free, do check out that link that Sandra put in there about signing up for office hours, because we'd love to walk you through this. It's not for everybody, but we're happy to do it. So, okay, well, thank you, everybody. Have a nice weekend. All right.